Hi there, welcome back to a new episode, new year, new episode, new us in many ways. We unfortunately we actually had a couple episodes recorded in the fall or in last month, and we ran into some technical issues and we lost both those most recent episodes. So unfortunately, we'll have to try and cover those topics again in the future because I definitely think that they're worth discussing. But we also wanted to take a little bit of a change in format for the new year, for the new season, and specifically try and focus on one current event topic and tie it back to how it may or may not impact us individually and the broader, founder community or small medium business community, especially in Canada, and try and limit it to one topic and keep these sessions sort of short and sweet between, let's say, 30 and 45 minutes. So something to look forward to. And if you guys have any comments, please feel free to reach out and let us know how you like it. Today, we wanted to tackle the recent events, especially in the U.S. in Trump essentially capturing Maduro. There's a lot out there. We're not going to go into a bunch of detail about the operation and what happened behind the scenes, but more specifically, how it's sending some shockwaves in the energy markets, specifically the Canadian energy markets, and tie it back to how it's ultimately potentially going to impact us and our businesses in Canada and other businesses like ours. And maybe I'll let you kick it off, Andrew. You had some thoughts about, how can businesses focus on, building that foundation in order to try and survive or anticipate and predict some shocks and predict some downturns and be better, better prepared for whatever comes. So what are your thoughts on that?
So yeah, I was just thinking that a lot of the time we get caught up in the whole growth at all costs, and it's just eventually it's essentially investing in growth all the time, and that's when growth becomes dangerous, right? Is that we start to forget the foundational pieces that goes into what makes a good business, a solid business. So that's the things that are important for a good business is capital discipline. Um, you know, um, and essentially, building that culture, building a solid, profit margin, that can withstand certain swings in the market, certain swings in the economy, where that profit can come in and can help solidify the business during times of crisis. And what kind of tied back to your point, Kyle, is that if we are seeing oil being one of Canada's main export to the United States being endangered because of the whole Venezuela thing, this might have an impact on the overall Canadian economy. Um, like I think a couple weeks ago, I was looking into the deficit of each provinces, and what's interesting is that all most other provinces report a deficit in their spending, right? Except for Alberta, where it actually reported a surplus. So Alberta being one of the main oil exporter, um, that this can essentially endanger that and put Canada in a very tough economic situation. And I think businesses need to start thinking about what makes a good business. Don't grow at all costs. Slow down. Think about profitability. Think about growing that profit margin and diversifying as much as possible to withstand the swings in the market, right? So that's kind of my thought on the whole thing. I'll let you guys. I'll let Mike have a word on this as well. Mike, what do you think?
Yeah, absolutely. Well, historically, Canada there has been a lot of discussion around diversifying some of its means of revenue or GDP, and one of those things was how it was going to deliver our resources, being oil. And one of the ways was the logistics of how it would deliver it. Another way was also the type of who the customer was, where we would be selling it to. So, like as of today, the U.S. makes up, I believe, 98% of exports, oil exports from Canada. So 98% of Canadian oil exports, I believe, are going to the U.S. So there hasn't been too much diversification there, but there's been talks about it. Just there hasn't been much action around it. Another thing, as many of our listeners would remember, is the Keystone Pipeline, which was how oil would be delivered. That's more of an infrastructure, which was very, it was very tied in with the U.S. and the U.S. had a lot of say into that. But that would have definitely streamlined the delivery of our product to the U.S. Neither of those things were executed on, and Canada has been left vulnerable for a number of years. Having no really direct pipeline or not enough infrastructure going into the U.S. and having only the U.S. as a customer. And now we are facing the potential of the repercussions of that. As if we're relying on one customer, the U.S. is our number one customer, and now that's at risk with what's going on in Venezuela, with Trump, with the tariffs. It's really, our economy becomes quite frail and very dependent on this one buyer of our product. So that's something that's, it's been a little frustrating watching that unfold, and there hasn't been too much. I know there's talks about acquiring other customers in the oil side, such as China. But I think now what's going to happen is that Canada is going to have to probably expedite the diversification of their customers for its crude oil product, and it's oil product in general. And it's likely going to go into the hands of a country that is not a friendly to the U.S. So that's another concern that I think is going to unfold. Now Canada needs to find a new customer, and they're going out there. Most likely China is probably one of the next nearest customers, and Canada is very close with China. But we know how the U.S.'s relationship is with China. So now we're starting to see this kind of division unfold.
Yeah, it is really interesting, like being based in that part of the country. We've been talking about energy security and trying to get energy to new markets for 20, 25 years. And for the record, both conservative and liberal federal governments haven't really, taken the bull by the horns and done much about it. I definitely believe that the liberal government has been, especially under Trudeau, was very anti-growth and very much, wanted to keep it in the ground for environmental and political reasons. So, which is their prerogative as the government in power. But I find it quite ironic that we're in this day and age, this sudden predicament, and everybody across the country is squawking about how we need to find new markets and we need to do this and we need to do that. And we should have been doing it. And it's too little, too late. We need to get on it, this urgent thing. But, the Venezuela thing is kind of, I think it's positive, but I also think we don't need to go into it in too much detail. But, contrary to some people's beliefs, I don't think that operation had anything to do with oil. It obviously will potentially help support. They have refineries in the Gulf that help process, and they've been purchasing Venezuelan oil in the past. So it's a very easy way of, to processing and to transport. But I do think that it had more to do, the political background on that operation had more to do with the adversaries of the U.S., specifically Iran, Russia, and China, and their varied footprint in that country. Venezuela, when they became ostracized and they had a bunch of embargoes and sanctions, they turned to those countries in trading. They were selling oil, they were purchasing weapons, and each of those countries had people on the ground. There's actually a really good essay that was done that was actually linked by an old Alberta Premier, Jason Kenney, who used to be a foreign minister in the federal government, talking about it. But it does still raise the question and the concern in the medium to long term, if our main customer, to your point, Mike, that's vast majority of our exports, and especially our oil, is going to the U.S. and the U.S. says, hey, we don't really want to deal with you anymore. Either you're not playing ball with the other trading items and the customs union that we have already, and we don't want to, energy doesn't really move the needle. It doesn't have the leverage that it once did. That's going to have a massive negative impact on our ability to come up with a new or, renew that sort of bilateral trading agreement. But it's also, to your point, we don't really have a lot of options in terms of where to take that oil. Like selling it to China requires a ton of pipeline infrastructure to get it to the coast, and then a ton of infrastructure on the coast to actually ship it, which we don't have. And it's going to take billions of dollars and many, many years of development and building. So it's really not an overnight, there's no sort of, quick moving here. But it is very interesting it's done a really good job of focusing people's minds on like, hey, what if we lost 30% of our GDP? Or let's say we lost 15% of our GDP. And we are seeing a lot of the Canadian energy companies, stocks being going down because people are essentially selling their stocks, or they're not anticipating that they're going to be able to make the projected revenues or whatever else. There's headwinds. They're predicting that there's going to be headwinds. That makes up a huge portion of the Canadian stock market, and so that value, that wealth disappears. We're seeing a lot again. If you're a major, let's say a major investor like a Shell or a Conoco, Snovis, are you going to be investing in Canada? Are you going to bring foreign and direct investment into Canada to pursue those oil and gas assets, considering what we know in the last 15 years in terms of the regulatory hurdles and the outright social, difficulty in getting stuff done? Or are you going to go to Venezuela? And so that, all of those things wrapped up really presents a pretty challenging future, a really challenging roadmap in terms of that whole industry. And so coming back to, Andrew's point about what does growth look like? And I would argue that those companies haven't been spending a ton of money on growth. I think they've had a really rough go of it in the last 10 years. And so they were probably 10 years ahead of everyone else in the country in terms of focusing, enabling that stable capital foundation, not spending a bunch on frivolous projects, not chasing the next big thing. They cut a ton of labor, they cut a ton of capex. They were really just focusing on the bare necessities in order to return cash to their stakeholders. So I think it's actually quite, somewhat the model that we're talking about. But it is interesting how it has done a really good job in some corners of the country to focus their attention on what do we actually care about it now that it's actually, on the ropes, and there's a really good chance that we're going to lose a huge chunk of domestic output.
Yeah, that's always a concern to me. Like, I remember, like, even 10 years ago, I was looking at at the Canadian economic diversity, by sectors, and that really concerned me about the whole TSX, right? We look at the makeup, the top 10 companies on the TSX. It's like all banks and oil
Thanks.
companies.
Yeah.
And what are banks? Banks are just, I guess tailored to our domestic demands, right? Like, so if there's low productivity, low growth, there's less spending, less consumer spending, less people buying houses. That essentially affects the banks, right? So it's all cyclical. And then, what really provides those jobs, are manufacturing, natural resources and energy, and then there's like construction as well. And if all these things is kind of like ties into each other, you're kind of in a tough position if it's not very well diversified. So, and back then I compared it to the US, where if you look at the US, you see, well, now the top 10 companies in the S&P 500 is very different. It's like all tech companies, right? Because of the AI boom. But for a period of time, it was very well diversified. It had oil companies in there, has tech companies in there, and it has companies that are essentially manufacturing, producing for the world, right? Rather than just focusing on the domestic market only. So an interesting thing is right now you look at the top 10 companies in Canada, you see Shopify being the only tech company that's there. And that was a huge red flag to me because it's just not very well diversified. And if there's anything that goes wrong in either consumer spending, housing, now the both ties to manufacturing and construction, and if those things slows down, yeah, like it impacts everything. It impacts like a good probably 80% or 90% of our GDP, right? Because manufacturing, construction, and I'd say the service sector is probably like makes up like 90% of the Canadian GDP, right? And probably a good percentage of employment as well. So we're probably looking at like about 80% roughly, 85% of the employment out there. So it's all cyclical. So we kind of put ourselves into the situation where we went really all in on a couple areas rather than diversifying into other aspects of the industry, like
We
other
should,
industries.
for our listeners, we should probably, maybe we could pull up a chart, Kyle, outlining, by sector, Canada's GDP and exports. Because just from a quick look, and I'd like to fact check this, it looks like, Canada's energy sector in 2024 accounted for 10% of its GDP. So
Hmm.
10%, that's just from energy, not including banking, not including construction, uh, and not including, real estate. But
Yeah, like
10%, what's that?
double check it, Mike, but I think it's like something like the service sector is the largest for sure, probably 60 or 70%. Is that correct?
And then exports. It says that exports, energy is 25% of Canada's total exports.
Total exports, but the GDP
GDP,
total.
yeah, I'd have to pull up the list, but yeah, it'd be
Yeah, I
good
think
to
that's
see that.
where my head is at is the export mix. So I'm definitely not a big believer in the whole if I sell you a penny and then you sell it on for another person for a penny, we've generated 3 cents in GDP value. Like I don't I think that's a GDP in many cases. It was not the appropriate term to use. And I don't think it's something as a country if we're looking to grow and increase our productivity, I don't think, and especially diversify our export markets, like it's
So what
not a
would you
useful
track, Kyle?
metric.
If you're not tracking or using GDP as that benchmark, what would you use as that benchmark?
So a big one in my mind that's an accurate display of health of the economy is foreign direct investment, right? Like, and that has been declining. Capital expenditure. So this ties back to the productivity issues within Canada. So they're the lowest performing in terms of capital expenditure across OECD countries, all OECD countries in the last 15 years. And so,
So you're looking at the flow of money, basically. You're looking at the flow of money into industry, either by
who's
private.
spending money,
Yeah,
who's
yeah.
spending money, and where is it coming from? So if we're not spending money on let's say plant and equipment, so that would include things like technology, AI. We're not upgrading manufacturing equipment. We're not investing in up newer, bigger, larger facilities. That money isn't being spent. We're essentially not investing. And then the FDI is a very similar metric. It's just someone from outside of Canada. So one of the big wins of the energy industry in my lifetime was the amount of foreign direct investment the oil sands attracted, let's say 20 years ago, to a point where there was hundreds and hundreds of billions of dollars flowing into Canada from other places that was then being spent to build out infrastructure in the oil sands, and countries like Fort McMurray, they benefited directly from that spending because all of these companies needed workers. They had workers getting bussed in, flown in. There was a huge dearth of housing, so they had to build housing. Construction materials, construction outfits, consulting, engineering, everything. The boom and the flow of capital that made, frankly, Alberta one of the wealthiest provinces in the country, if not the wealthiest, was typically driven by money from outside the country. It wasn't displacing, it wasn't a zero-sum game where, Nova Scotians were losing because that investment was flowing to Alberta instead of Nova Scotia. It was coming from elsewhere. And so I think that's for me personally, I think that's a really clear target, is if the country can be comparative to other countries and attract those multinationals or attract that investment where people are choosing to spend dollars in Canada, it makes Canada and everybody around those projects better off. And we should be
Yeah.
focusing on that.
Well, I guess the leading indicator then would be the exports. Well, not necessarily. They're not directly correlated, but they're somewhat correlated because the more Canada is selling of its product to external countries, or the more the more revenue they have coming in, and the more resources they would require, the more investment they would require to stimulate that, to support and stimulate that. That could be
Yeah. So
one of the ways.
the economy is essentially either consumption based or export based. So somebody has to buy the products. And what was interesting was, again, in our lifetimes, the US economy transitioned from an export economy to a consumption based economy. So some of the largest companies in the US are things like Walmart and, healthcare companies and so forth. And those are obviously directed at internal spending. I've heard recent statistics that the US consumer market makes up over 40% of global consumption. Like, it's a massive consumer market.
Yeah, I remember talking about that on one of the podcasts. Like they're just
Yeah. So like we as a country, like we're definitely a consumption based economy, right? And that's partially propped up by this real estate, gambit, whatever you want to call it, where, a lot of wealth, a lot of GDP, a lot of quote unquote value is created in the real estate industry with appreciating assets. Whereas it's not where we should be probably focusing on as a small resource based country is on exports, on how do we actually sell our product elsewhere without just draining our own bank accounts.
Bringing in external dollars. So let's look at both. Let's look at the breakdown by category for both, just so our listeners have that. We have that. I have the exports by category right now, so I'm going to go through that, and maybe someone could pull up the GDP by category, so we know. Just for clarification, so this is what Canada is exporting to foreign countries. So energy is the leading export of Canada at 22%. That's oil, gas, electricity. Next would be motor vehicles and parts. I did not know that. I guess the parts, yes, but
Ontario is a big manufacturing hub for a lot of the auto parts and everything like
parts
that,
for
right? So
parts.
yeah,
Vehicles, not massive. I wouldn't say we're doing a lot of vehicle manufacturing, but definitely a lot of part manufacturing.
yeah, probably high up there though, because with Windsor and a couple of, I think they're not as much as I think Mexico, but I think we have a couple of vehicles from like Toyota, Honda that are being manufactured here in Ontario.
That's true. That's true. So yeah, that's 15%. Consumer goods is 11%. That's food, household goods, pharmaceuticals. And then at 9%, you have metal and non-metallic minerals, steel, aluminum, potash, gold.
So
And then
natural
8% would
resource.
be machinery and equipment. Forestry products is 7%, which is all your lumber, pulp, paper. Agriculture and agri-food, wheat, canola. I think that's really big here. Wheat, canola, processed foods, 6%. Aircraft and transportation equipment, 5%. And then chemicals and plastics at 5%. And then the rest is just miscellaneous. So
Yeah.
that's our breakdown of exports
Yep.
currently as of 2025.
Yeah, it's like, especially in Canada, it's like it's just too much exposure to commodity. If you look at it, there's a lot that are around oil and gas,
Yep.
mining,
Forestry.
electricity,
Yeah.
agriculture. It's just too much exposure to commodity cycles and things like that, and like really competing with other countries that has resources that can, it can change the demand. The demand can change very rapidly, and having all of our essentially eggs in that one basket is very risky.
Yeah, it's about 40%. If you add them all up, it's about 40%. So almost half of our exports
Yeah.
are
Yeah.
yeah,
I think the
natural
challenge
resources.
as well, like to your point about Shopify though, like we as a country in multiple provinces have been talking about diversification for decades, and it's really not easy. Like it's there's so many things that go into the scope and scale required to be able to build really successful, let's say, technology companies. The other challenge that Canada has long struggled with, and it's self-imposed, is that they make it really, it's very unhospitable to keep your company here, right? Like the old build and sell Canadian model, like that's unfortunately that's it's stereotypical, but it's very, very true. Like the larger companies that I followed earlier in my career, they all were sold to U.S. conglomerates, or the founders left, they relocated. Like even energy companies, local energy companies, they've set up main offices in Denver, Colorado, U.S. states in order to primarily access capital markets. Right, we just can't raise money in the startups can't raise money in Canada. There's just not enough capital. There's not enough risk, and so it's interesting because Shopify is 100% the exception to the rule. Like they are the outlier, whereas pretty much every other company has relocated and moved away from Canada for a bunch of other reasons. And those reasons are not, they're not popular. People don't want to talk about them. They don't want to tackle them. They don't want to talk about high tax, low return.
I'd
They
like
don't
to
want to
double
talk
click
about
on that
infrastructure.
topic. I'd like to double click on that topic. Why the model in Canada is buy or grow and sell, and we're seeing that, and we've talked about that in previous podcasts. How much acquisition there is, where there's so many businesses and so many different industry verticals that just end up selling their business. And Andrew, we were talking about this just the other week about Canada loves its oligopolies. Like these companies just become bigger and bigger. Like one of the reasons I think is for market share. It's so difficult to gain scale and market share in Canada, due to the limited size, the limited reach, the provincial jurisdictions, how they're so segregated. But Kyle brought up some reasons: raising capital, taxes. What are some other reasons? Let's brainstorm. Like why do
Right.
companies end up
Yeah.
selling out here or trying to get this massive scale and not just
It's
not buy hold?
It's interesting because, like we just, it's funny that Michael and I had this conversation just recently, and yeah, if you look at some of the new entrants into the Canadian market, none of them have done exceptionally well. It's almost like, we Canadians, the Canadian market is a bit more resistant to change. So you look at Target entering into the Canadian market, didn't survive. Nordstrom didn't survive. Talking about the telco, the one time they opened up the bands out to the international players like Win Mobile didn't survive. Some of these guys just didn't last, and they end up being acquired by the big three again. And then, like, again, it's just like there is no there is it's just a very big resistance to change. It's almost like they're having this mindset that says if it's not broken, don't fix it, kind of thing, right? So it's an interesting one because it definitely I'm thinking that's might be part of the reason why we don't see the level of innovation and the level of change that we see in the US. It's just the US is more willing to, I guess, experiment and try. It's just they're more open to these kind of things. And it leads to more, I guess, opportunities for other businesses. So you think about it, if Canadians are not willing to switch and give opportunity to new entrants, how can they survive, right? Like how can they, if you don't walk into a Target, to give it that opportunity, I'm going to continue to go here, say Walmart, Target wouldn't survive, right? And that's
So,
really what it
I,
is.
just on the Target point, I think it's worth pointing out that, especially for US listeners or people that are used to the US experience at Target, the stuff that Target set up in Canada was nothing like the US Target. So I think a main criticism from people that I know, especially, was that they had a certain brand expectation walking into a new Target store in Canada, and it was nothing like the Target experience in the US. In fact, in many cases, there was one specifically that I know of where they just essentially took an old Zellers store over and repurposed it with their merchandise, and it's not. I would argue that's not going to be successful, and they probably should have known that was going to be successful. You can't just trade on brand and forego that experience with the brand that people are looking for. So I do think that there were other reasons than just, the Canadian consumer didn't follow through with what they wanted or whatever. But I do also want to draw attention back to the fact that we're not a big country, and we're not going to build these, global behemoths that are competing on the world stage by selling to Canadians. Like, we have to come up with products and technologies. Like Shopify is a perfect example of that. They have a very diverse global trading base. Like, I don't know the statistics, but I would guess that far more than 95% of their stores or their vendors are based outside of Canada. So their revenue, vast majority of the revenue has got to be coming from outside of Canada. They're choosing for personal reasons to stay in Canada. Tobias Lutke has publicly stated over and over again he wants to stay in Canada. He loves Canada for all these different reasons. It's not a financial. None of them are financial. None of them are business related, right? They're all personal reasons. So I do think, if we're talking about resiliency and how to build the economy, how to diversify, we're not going to do it through Canadian consumption. We're definitely not going to do it taxing and regulating the heck out of ourselves. And we have to be realistic about, what are we expecting? Like, what do we want to see change in the industry? What are we expecting as the population?
Oh, yeah, I definitely agree with you, Kyle. But like, if you're not in e-commerce or technology, it's very difficult to get that global scale. If you're selling a product that's logistically very difficult, or a service is even harder, a service that's delivered by people, how do you get that global scale? So we all start with the easiest sale is your locally. So we're selling to Canadians, but as Andrew mentioned, Canadians, and we've all experienced this, are very hesitant to change. They're very comfortable. They're very comfortable people, and if it ain't broke, they don't want to fix it. And I agree with that. And I'm thinking about it. I'm thinking about all my friends and contacts, colleagues in other countries, and where they go to school. That's one of the things, and where they live. I would say a strong majority of them end up going to school away from where they've grown up. They end up starting a family and working, in a different state, a different city for sure, a different state, potentially even a different country. The Aussies were like that. The Americans were like that. Europeans are like that. They'll go work in a different country in Europe. Canadians, really don't like to change too many things up. They like to stay put and stay close. And even when we're trying to sell things to Canadians. They're very resistant to trying something new. It's like, you know what, I'm comfortable. Like I'm happy with what I have. It's pretty good. It's not even a great experience, but it works. So, you know, it works. I'm happy. I just don't want to cause any more friction in my life or any kind of take any risk. If I pursue this, I might be taking added risk in pursuing this, and I might make my life more difficult. So I'm just going to leave it alone. And I think that is kind of like, if you peel the layers of the onion, that could be one of the detriments to Canadians is that.
Yeah,
Think how
it's
hard
like,
it is to cold call and sell, Kyle, to Canadian businesses.
yeah, it's
Yeah,
They want to change.
the aversion to change is huge, like
Huge
absolutely
here.
right. And I do think that there's, I do think it is going to change. Like I think a lot of that also has to do with the people that we're talking to and the demographics. Like, we're coming from it from young, founders that have started businesses, and we have a long runway ahead of us, for better, for worse. Whereas a lot of people are, late 50s, maybe even late 60s, that are really not in the mindset of changing. Like I
Yeah, I
might
think
have
that's
brought
it.
up
I
this
think
story previously.
it's more of a demographic thing. You're right, because I just think
Yeah.
about our parents. They're probably going to the same grocery store they went to for 20, 30 years, if it's still around. They're going to the same dentist, the same. There's no changing, especially for that generation.
No, and I do think that will change though, and we are seeing it in our business where the old guard really have no interest in adopting anything new, especially AI related. If they don't understand it, they don't want to talk about it. Whereas the younger generation, it's really a huge shift. It's no longer they're interested in the relationship trade. They're looking for dollars and cents. Like they want tangible benefits. They don't care about what sort of value add
Where does that
you
start
think
at
you bring.
millennials, or you're saying even younger than millennials? Because we're on
I
the
would say
cusp.
older
But
than millennials. So let's say Gen X and under. So people that are, let's say, in their 40s or 50s right now, that they probably a little bit younger than 50s, so maybe 40s, where they're essentially coming in and they're replacing people that are retiring. One example we see quite often in the risk or the insurance world is a senior risk person retiring and then their job being taken over by a young finance person, and that young finance person essentially says, look, I need to get this done. Like, I'm focused on execution. I don't care who you are. I don't care what the relationship was with my predecessor. Like, I've got to do it in my way. And that's, it's a far more quantitative sort of analysis. And so I do think that that's going to change. I think in the next 10 years, next 20 years at the latest, I think you're going to see a huge change in how operators, how business owners, how businesses themselves are run. And that, it may or may not change that risk aversion. But if I were a young person in a legacy business being promoted, I would probably want to do things differently in some ways, I'm guessing. So
I don't have much confidence or faith in that, Kyle, to be honest with you.
okay,
I think
why not?
yeah, it's just the impact on the younger generation. It just makes it really difficult for them to change their mindset, considering the fact that they've been less successful than their parents, and that's Gen X are less successful than their the boomers, and then millennials, same thing. We're just it's just a bit of a lag, right? And I think because of that, don't you think they become even less, risk taking? Like they become even more conservative in their decisions, more afraid to make, decisions on and take risk. They just, I think it's just, yeah, sure, they'll adopt technology, but that doesn't change the mindset of, say, I'm going to take this risk and I'm going to adopt AI, or I'm going to take this risk and I'm going to do things differently. I just think that mindset starts at, like many generations. It'll take at least like 2 generations, 3 generations to kind of flush that out of the system, right?
Yeah, I'm not seeing that though. Like if you look at essentially like where young people, and we're talking much younger, so we're talking more so younger than millennials. They're
Gen Z.
look at
Gen Z would
the
be 13 to 28 years old, and then Gen
yeah
Alphas are 0 to 12.
But you were
yeah.
seeing
So not Gen Alphas.
we're seeing the Gen Zs. They're I read a report recently is that their focus is not really on career or savings or anything. Their focus is on traveling, guys. Like the focus is shifting, is changing.
So that I agree with that. That's a broader discussion though about like the whole generation. I think the people from that generation that are in positions of decision making. Like look at the increase in, let's say, like Polymarket and betting and stuff like that. Like the younger generations are far more likely to take huge risks. And I agree with the sentiment that you said about they have been less successful. They have less doors open to them. And so for the people that have doors that are open to them, they're not just going to sit back and rest on their laurels and do the same thing that their predecessor was doing. I do think that they're going to swing for the fences and they're going to try and make it, in their own image. They're going to take big risks because their generation has grown up being taught that you need to take big risks to win, which I think is actually quite accurate, right? And there are going to be, I agree with the sentiment that there's going to be some that are risk averse, but I don't think that they're going to be put in those positions. And if they are, let's say a family, succession plan or whatever, I think that that business will inevitably struggle, and then it's going to be again sold or passed on, or new management's going to come in, and that's where that.
But like if that kind of what you're saying, Kyle, it encompasses a lot of different things that has to happen within the country, within the province, within the the jurisdiction that allows for some of these things to happen. These activity that you're talking about, so for example, Polymarket. You're talking about Polymarket. Polymarket is not available to everybody in every jurisdiction. Right, like they're in Ontario. I don't think this has been even available. I don't think you can go on there and make bets on it. Right, so there's these certain limitations that are making you just kind of setting you up in a position that you're just risk adverse in general. You can't take the risk even if you wanted to. How can you do it? How can you grow up with this mentality?
So you can get access to those prediction markets, and like Robin Hood taught us that as well 10 years ago. Like younger people wanted to do that sort of gamified stock trading. So
No. They want.
I
Doesn't
don't
mean
think that it's
allowed in the jurisdiction, right? And I can tell you in Ontario is not available. You can't go on and access it. You can't sign.
Can't get cashy or anything in Ontario.
You can't access Polymarket in Ontario. Period. Yeah,
That's
it's not possible because I know people that have tried in Ontario to make the bet
No names.
Canadian elections, and they could not get access.
Andrew couldn't make money on that bet.
Say you're from outside of Ontario.
Maybe I saved money.
But no, like the point I'm trying to draw is that you wanted to make the bet, and people do want to make the bet, and there's always going to be outliers. But I do think, again, just based on my personal experience, I think the younger generations are far more tolerant of risk, and I partially think it's also that they have all less to lose, right? Like I do think that the boomer generation was. And the people that are retiring, like, again, they don't want to rock the boat. Why are they going to make a bunch of dramatic decisions? And this comes back to that stable foundation. They're not going to spend a bunch of money. They want that money.
They've made their money. They're asset rich right now. Now they're in a preservation state.
And then think about as they start selling off these assets, it's going to have an impact on Gen X, millennials, and probably Gen Z that are buying into these homes that are now losing value. So we're seeing that right now, right? And that's essentially what's happening is that the millennials and the younger generations are really suffering as these older generations are cashing out, and that creates less opportunity for them. They don't have the asset to really take these risks anymore, right? It's just, I think it takes generations to actually change that mindset. And
who's buying the asset? If I'm selling my car wash business, who's buying it? I'm not selling it to a boomer.
But they might be selling it to a younger, a millennial or whatever.
Millennial would probably
much
buy
lower
it. The millennial is
price.
the only one that would be in the position.
Yeah.
Millennial or Gen X.
They would buy
is
it, but at a much lower price. But the previous millennials that were buying it, or the Gen X, they're going to lose all their assets. Like they're going to lose their retirement essentially locked up in that house. And that's what's happening right now in Ontario, as asset prices are just crashing. Right.
But okay, but why does that impact the millennial? The millennial doesn't care about retiring right now. Like why would a millennial not take a swing at buying a business and taking on that risk?
There's less capital. When you have a house, that's appreciating in price, you open up that home equity line of credit, and that's what essentially allowed, this whole thing to get out of hand. Is that they took out a line of credit to buy more homes, so they just kind of fed this thing. But so the home value goes down in price. There's no leverage that they have left. The equity they have in that house is completely wiped out.
But businesses don't usually, well, I don't know for sure, but like most businesses don't trade on home equity. right? Like they're
Well,
essentially
for you
funded and
for you to essentially get out there and start your business, you need some sort of loan because no banks is going to let you borrow money right out of the gate, right? You generally need most business owner, I would assume,
Unsecured.
yeah, take
but you
take.
borrow against the business, right? You borrow against the future cash flows of the business.
But the business
That's
doesn't have anything. It's not in existence right now, and the bank is not going to let you borrow if there's no like any significant amount of money if they don't
Yeah, banks are very conservative.
they're
They'll
very
give you
conservative.
some money, but very little money.
Yeah,
You could go to other facilities like BDC where they're just a little bit more, a little bit more lenient and would put
a
out
bit
more
more
money. But
lenient.
typically, if it's not secured by some form of asset, so if the business doesn't have, a
Yeah,
big building, a property, then it'd have to be
and usually
secured against the
to get
founders or
these.
the owners' their residences.
Yeah, and usually they ask for like security. Like you put down your home as collateral, to borrow that
Mhm.
money, right? Even
Yeah,
if the
Well,
or
you
you
get a
borrow
personal
against your home.
guarantee, which would
yeah,
include your assets. But the point is that a lot of businesses, most businesses, I would argue, don't trade based on personal guarantees. Like you're borrowing on cash flows, you're lending against again like the business
Yeah, once
assets,
you're
like you're saying.
established. Once you're
once you're
established, yes.
established though, like
Yeah, but that's what we're talking about. Like, we may be talking about different things. Like I'm talking about legacy businesses, boomer businesses that have been successful, that are generating cash flow, that have assets, where the people are looking to retire and they're selling those businesses to the younger generation. And the question is the younger generation, however they're going to buy it, there's multiple ways of buying these without personal guarantees. Let's say you don't have any personal assets. You get a seller earnout, you get seller financing, whatever. There's ways of doing it. Anyways, these new people buying these businesses, do you think that you guys would come into a new business that's not, sorry, not a fresh business, but a business you've just purchased that's been operating for 20 years, and you wouldn't change anything because you'd be too risk averse? I struggle to believe that.
I think it's just they're gonna make some changes, but it's not gonna be that drastic because it's too risky. Like they essentially borrowed a bunch of money. They're gonna just continue to milk it. In my opinion, that's what's gonna
I
happen.
disagree with that totally. What
Yeah.
do you think, Mike?
What do you think?
Yeah,
Two different
I
views
think.
here, you know?
Very different views. Andrew and I
Yeah.
have different views. You've never heard that before, have you?
Yeah, I guess it depends who's coming in. Like if it's a Gen X coming in or a millennial, a millennial probably would. A millennial probably would come in and try to extract more EBITDA out of that company and try to make a little bit more money and make changes. Typically, that's what we see, anyways, with our businesses that we insure. When they're buying companies, they're trying to streamline and automate certain things to make that business more productive or more profitable. So yeah, they probably would try to do that, Andrew.
Yeah, so
Don't you think?
I guess the key is, the question is, are they going to actually grow the business or are they going to extract EBITDA, which is now,
Yeah, yeah. So now that's a
harming,
different. Yeah,
jobs, they're cutting out jobs. Like we see that with private equity coming into Canadian businesses and try to extract more EBITDA out of these companies. That's a different
they are
story.
going to try to grow them. I don't think they're
Mm.
going to go super aggressive on growth. You're right. They're not going to go super aggressive on growth. They're obviously going to try to grow them.
Okay, so
But
tying it back to the original comment, because we're short on time, what are those businesses to do? Are they to avoid growth, Andrew? Like you were saying that you need to be obviously very conservative, not to bet the farm, which I would agree with. But at some point, you actually have to grow if you're going to survive. If your main customer no longer wants to trade with you, for example, what are you to do? You're finding a new customer that takes capital, that takes time.
I think growth is super important. And I think, Andrew, what he's trying to get at is disciplined growth. I think sustainable, disciplined growth is the key to every business. Yes, obviously, you have to have all the foundation in place. You have to have the right processes, the right people. You have to be the right unit economics. The unit economics have to make sense. However, if a business does not grow profitably, sustainably, responsibly, it'll just die off. It'll whittle away, or it'll just plateau, and it'll never be of anything of any real enterprise value. Think about yourself as a buyer. If you're buying a company, yes, you're going to look at the profitability. Andrew's right. You're going to look at the discipline. But if you see growth, that's consistent growth, and that's disciplined growth, and that's the business is still lucrative. You're not trading off too much. I think what Andrew's trying to get at is you don't want to trade off too much profit and take on too much risk in exchange for growth. It has to be done responsibly. Because
100%.
we've seen it. We've seen companies just chase growth and just deploy everything. But that's more of a venture model. Like this is more of like a startup or a venture-backed business. Venture-backed businesses will sacrifice everything for growth. And Kyle, you're aware of this. You know, like the everything is based on growth, and that's, you know, dangerous, and
Yeah.
it's difficult to sustain that over a long period of time without constantly refunding it.
Yeah, like just for the record, I'm not anti-growth, like Mike's saying, I like what you've said there, Mike. Responsible growth, right? It's really the key here is that, you have there's a time and place for everything, and there's a market for growth, and there's a market to essentially tighten up and, have to have capital discipline. Because what can happen is a lot of businesses, they focus so much on growth is that the leadership becomes allergic to slowing down, right? They just the moment they hear slowing down, they're like, oh no, like we can't do that, right? And then, when there's no margin left for them to do anything, options disappears. The option to acquire, the option, like the options to get a loan disappears because they're running at a deficit. And then, headcount grows so fast that revenue can't catch up. And we see that with a lot of businesses, and especially businesses around COVID, where they're just hiring like crazy, and then the revenue couldn't support, and then they have to just start cutting costs, right? Cutting fixed costs because those things are just growing and getting out of hand. So it can be very dangerous in that sense. Is that
Growing the infrastructure before you have the you know, the revenue to support it, and also the
exactly?
CAC. You have to really be mindful of your customer acquisition cost, because, you know, if you're growing but your customer acquisition cost is through the roof, you know,
Yeah.
are you real? Is it, does it really make sense? Like, unless you have a plan or levers you can pull to bring that right down. But like Andrew said, it's very difficult. It's
Yeah, and
easier said than done.
yeah, I know a lot of these failures, they don't like really happen overnight, right? They compound year over year, and then, the leaders of the company often just ignore it, thinking that, hey, you know what, I'm chasing the revenue. We continue to grow the revenue, we're gonna hit profitability, but they don't understand that the fixed costs and the head counts are gonna just grow exponentially along with it, right? So it becomes very dangerous. If you just focus on growth alone, and I remember seeing this TikTok video or this short that's on Instagram of Elon Musk going into Tesla in the early days. And it kind of resonated with me because, the first thing he came and he said was that we got to get this company to cash flow positive within 6 months, and that was his mandate. He stepped in there, and this is what he says, and that makes a lot of sense, and that's what made Tesla survive and got to where it is today. Is if that
You know, it'd
company
be
could,
great, Andrew, to find out what he did to get there, because I think we can all agree that cash flow is king. I think we talked about this too, and you speak to a lot of good business owners, and they always say cash flow is king. Cash flow, cash flow, cash flow. I think Warren Buffett's big on cash flow. I wonder what he did to get there. Did he
yeah, cash
continue to
flow
grow the
positive.
revenues?
Yeah, like it'd be interesting to find out what he did after that because it's there was an interesting one because it's a lot of people forget that being in a cash flow positive position is very important for many things.
What do you think, Kyle?
Oh, I would agree. I think it's a lot easier said than done though. Like I think it would be interesting to take a deeper dive into companies like Tesla and X and stuff like that, but it really comes down to limiting expenses and growing revenues. And yeah, obviously it takes money to make money. Like you're not going to start selling more cars if you don't have the equipment ready to build them. So you gotta put together some sort of a plan and estimate, but inevitably it involves some level of risk. It involves some level of spending before you have it. And that's frankly why the venture model has been somewhat successful, right? Is they've dumped a ton of capital. Companies like Uber wouldn't have existed if they were trying to get to cash flow positive,
Yeah, but
right? Or if
it's
they needed to.
but when you say that's like 1 in 1,000 or 1 in 100,000 that they like the venture model is like investing in like 99% failure and that 1% unicorn, right? So that model works, but only for a few really solid ideas.
Good
Yeah,
point.
I don't know that I would agree with that. I think that the venture model, in terms of the returning of the portfolio, is 1%. But I think that if you throw a bunch of capital at growth and you grow a company to whatever that size is, you can then sit back and harvest those gains. I think most companies would grow that way. So the argument is well, how much are you spending to what's that CAC, what's that long term value, in order to get to that sort of plateau where you're able to sit back and farm it. In many cases, those companies would be going public, and what is the dividend return for that cost of capital? If the business is spending a ton of money on growth and they're not getting the growth, that's the failure. That's where it's happening, right? And throwing more good money after bad, that's venture companies don't do that. Venture investors need to see tangible growth metrics. They need to see customer acquisition costs. They need to see those metrics. And then what they're doing is they're essentially throwing fuel on the fire, right? In order to get to that, sort of sizable market share. Now, the Uber example and many others is you can't do that. You can't actually grow and spend that money if you don't have it. And if you're trying to cut expenses or not build the product or whatever else, like hardware, especially, it's a miracle that hardware stuff gets built at all, because it is so capital intensive, and you essentially have to build it before you have the chance of generating any revenue, right? Cars are a great example. Tesla's a perfect example. You have to build all of that, machinery, equipment, warehousing, all of that infrastructure, all of the engineering, all of the design before you can sell the first car, before you make your first 10 grand. Like that takes a lot of capital, and there's no way that you can get around that.
Yeah, there's definitely, what I'm saying is not like you don't invest in growth, but what you have to do is essentially there should be periods of time that you slow down, and really analyze that, right? And seeing, is this growth sustainable? Is this the proper way to grow, right? Or do we continue at it, slow down, and then fix all the infrastructure, fix the foundation, and then continue pushing on that growth, right? I think it's just, having that straight path on, paying for growth and growing at all costs is not sustainable. I think the business has to be flexible enough that it says, what, this is the year, or this is the time when we need to slow down, because growing all costs is not the solution, right? And then fuel the fire again. It's just that's what I think is like healthy, responsible growth. But you're right, there are companies who just maintain a net negative position for many years, and then they explode because they pretty much captured like a good chunk of the market.
Yeah, we should actually do another episode,
Yeah.
talking about those acquisition costs and how to value long-term value and stuff like that. Like, it's interesting being in the SaaS world, the software world, where there's some very, very well thought out calculations and sustainability and all that kind of stuff in terms of what you should be charging, how you should be growing, what you can invest in and acquiring customers. And it offers a lot of red flags, right? If you're essentially, like you say, if you're spending more to acquire the customer than you're making in the lifetime of that customer purchasing from you, then that's not sustainable. You need to do two things. You need to either charge them more, so you need to increase the amount of money that they're going to pay you over that lifetime, or you have to cut your acquisition costs or your expenses or whatever. However that cost translates, however you come to that. If you're amortizing all of your fixed costs, so you got this massive luxurious office, that the customer has to pay for that. If you're not charging the customer enough, you're not making enough money, they're not paying for that office. So I think it's worth having a broader conversation about some of those metrics, just to tie it back to, like, I do agree with what you're saying, like, and you use the Meta example where if you're going to take a shot in the dark, like, you got to make sure you don't miss if you're going to bet the farm. Like, and there are companies lots and lots of companies that do that, and it's been, unfortunately, it hasn't been successful. But we're getting a little long in the tooth for this episode. We've already broken our first rule of our first episode. So why don't we put a pin in the discussion till another episode, and we can come back to it. But thank you for joining us. It's been good to be back in the new year, 2026, and we look forward to chatting about this and other content, other topics in the future. So thanks again.